really worried about accounting 221.
Don't be. It's Kathy teaching it. It'll be easy. Wrong again, human.
Professor Raptor!
That's right, food/students. I couldn't help but overhear you, and so I'm here to educate you.
What do you mean?
Why do you think we dinosaurs briefly went extinct? Well, you're wrong. Dinosaurs briefly went extinct because we thought accounting 221 was easy. Luckily for you mammals, I'm here to educate you. Just remember, everything relates back to assets equals owner's equity plus liability.
What do you mean?
Sorry, I forgot I was talking to humans. Assets are things like cash and this dorm room.
Yeah, how did you get in here, by the way?
Liability and equity are claims. Liabilities are creditor claims, and equity is investor claims. Liability includes money you owe, like to the Dino Mafia, and equity is made up of common stock and retained earnings. Now, what do you kids know about transactions?
Like when I buy a candy bar?
Or when I buy staples?
Staples?
Good job, mammals. You got at least one right. To do this, you have to debit one account and credit another.
So I debit cash and credit expenses?
Oh, seriously, can you stop?
Stop what?
Everything, human. Everything. You would credit cash and debit food, a net asset change of 0. And once you ate the food, it would be credited and you would debit its expenses, which would be an expense for owner's equity, taking away from retained earnings. Remember, debits equal credits. This example seems simple, but it is important that you get this stuff right, especially when you work for the Dino Mafia. Which I guess brings me to inventory. You guys know how to expense inventory? Probably.
They took your teeth?
Typical humans. The most common methods of expensing inventory are LIFO, last in, first out, FIFO, first in, first out, and the weighted average method.
First what?
I'm glad there weren't any clicker questions on this. Typically, when a business sells inventory, it only expenses based on one of those 3 options. FIFO means that they expense based on the cost of the first purchase of inventory they made to the last. Then LIFO is when they expense from the latest purchase of inventory to the first. While weighted average is simply the mean of all of the costs of inventory.
So, since there's almost always inflation, that means the LIFO method will have higher COGS.
Correct. And because its COGS are higher, its retained earnings are lower. So why would they choose this?
Because we're stupid mammals.
Close, but wrong. This is done because inventory is already paid for, but just not expensed. A higher expense means lower profits and lower taxes. However, cash flow is the same either way, so the lower taxes let you keep even more cash.
That's really confusing.
That's why the dinosaurs went extinct. Just remember, FIFO means higher retained earnings, higher taxes, and lower cash. LIFO means lower retained earnings, lower taxes, and higher amounts of cash. So the most important thing to remember is you can't present your stockholders with FIFO accounting records and then present LIFO for taxes. Any other questions?
So assets equal debits minus credits.